Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Oh boy, oh boy, oh boy. So this is what we got this morning. Now, this is all gibberish in some regards, but meaning Trump is really the master of confusion, distraction, leverage. Trump is considering a national economic emergency declaration to allow for new tariff program, but WayPro just said the opposite, and they even had 3 sources. It's, again, we're getting a lot of mixed signals. Welcome to the next 4 years. But for right now, my 10-year, 2-year yield curve is moving into this positive 0.45. That doesn't mean it's going to stop there. The problem is that as soon as it kind of creates this pattern, beautiful, by the way, on a weekly, it becomes very powerful. It creates this scoop, and then of course it takes off. And then once it gets above the prior breakout level, which was September, basically this whole, we're going to cut rates 50 basis points kind of thing, which was literally right here, September 16th. We got that 0 hit. And then again, December 12th, I was in, yields are gonna spike. So we did. It doesn't mean it's done. It means that it's picking up speed. So the 10 is falling faster than the 2. And you can see that with the side-by-side 10-year T-note futures on a 1-day. And here it is with a 2-year. You can see how the 2-year is not falling, but the 10-year is falling faster. And that's what kind of creates this steepening, which is going positive. So I decided, okay, this is working, and yields obviously are picking up, right? So we've got a situation where we're up to this 4.69. Let's call it 4.7 because that's what it hit earlier. So we're there. Okay. And the dollar's bid. Okay. And folks are getting nervous, but we haven't poked above this 109.30. Remember, we hit here and then got, boom, dropped, interestingly enough, exactly at resistance. So the market's going to get a little bit more nervous as this picks up speed. And it looks very similar, by the way, where yields have moved higher, pulled back, gotten some energy, very much got supported. Here's the daily look, the weekly look, but they very much got supported at that 105.40 and it moved into 109 with the next area up here in this kind of 110.80 area. So 110.80 is kind of coming to a theater near us, and everyone's trying to place their bet. Okay, so at what level does the US dollar become a headwind to equities? We're getting above that 109.30 is definitely a good start. Getting above 110.80 is going to be a big moment, because this is where global central banks coordinated to intervene with a 1.5 trillion, according to Matt King from Citibank, and helped support bond bulls and equity bulls back in September, October of 2022. So we've got a situation where, yes, it's kind of moving higher. And with that type of headline, guess what it does? Yeah, it goes right risk off safety trade into dollar. So that's just what we've got for a backdrop in the macro crunch. And then, of course, the oil is still firm, but not throwing up. But this is a headwind to equities. Financing costs are a headwind to equities as yields are moving higher. The dollar is a headwind to equities, or I should say corporate earnings. So if you have this trifecta of higher dollar for companies that derive revenue abroad, it's a hit. If you have higher financing costs, higher energy costs, it's a hit. So we're not going to see that in Q4 so strongly, the trifecta, but we probably will see it very, very much in Q1 of 2025. So kind of looking ahead, 2025, what will corporate earnings look like? They're expected to rise 10 to 15% this year. So what will they look like if we have pressure on margins from the dollar, refinancing, and energy costs? So that's what we're kind of the market's trying to price in, or any intervention that would come in to obviously interrupt this flow, which is bullish dollar, bullish yields. Equities are getting a little soggy. Gold is actually picking back up, which is one I'm very interested about, because we've got the dollar yen to also pay attention to. If the dollar yen starts to come down, gold is going to start to go up. I think it's time to start paying attention to it. I did mention end of January. I'd be much more interested in the gold and yen and all that jazz. But in the meantime, we're kind of working with the chop since November election into potential drop, but we're not there yet. But my dollar yield ratio is spiking higher. Okay, so this is just a reminder that September 16th, 17th, 18th, but 18th pre-market, I said, okay, time for a yield spike. Then that yield spike got way busy. Like I was just giving it 3.6 to 4.1. Remember that? And then it got above 4.1. Like, holy, this thing is strong. And risk premium started moving higher with it. And then that lovely yield curve started giving me indications that it was going to continue higher. And that's when I updated on December 12th with the client post, yields about to break higher. And I updated the TLT and the ZN bond short, the dollar yen long, even VIX, because I'm like, hey, I've got to get some protection here for February. That actually happened and triggered a little bit quicker. And the dollar too. So all of this stuff is still in play. January 8th, we're still in play. And then I had posted, remember the 2 yield curve chart at the time was only 0.11. Bonds got defended back here. We talked about that in April, and they were, $84. 10-year was at 4.7, and they tapped it down. So we're getting back into that area. We're getting back into that 4.7 area right now with this move into plus 45. So yeah, this was the time for a yield spike. We got it. And then we digested in this yield curve, but yields still started moving higher. We know that. We covered every single morning. December 12th, yields about to spike higher. They have, and they continue to. And the rate of change right now is what now has the attention of everybody as we get back above the 4.7 mark. Now we just hit the 4.7 mark. Trump came in yesterday and said yields are too high, which is kind of ironic. He can't talk those down anymore. Not yields, not dollar. But the problem is that the yield curve is steepening now at a faster rate of change. That means the 10-year bond will fall faster than the 2-year. And it's a big problem for equities if and when the 10-year gets above, I think now, 4.79. So we're at 4.69. That was, when I wrote this yesterday afternoon, which is really not so far away. So as the 10 and 2-year yield curve gets up to that plus 4.5 and the 10-year yield gets up into that 4.79, we could have some intervention. We could go sideways, or we could actually start to see equity volatility. What has happened in the past is intervention. And Trump even came in yesterday, but then he messed up. He flipped the whole thing upside down by this, considering a national economic emergency. Come on, about tariffs. So in other words, instead of a gradual tariff rollout, he's talking, let's go back to the 1950s. So okay. Anyway, yields are leaving the Goldilocks zone. I mentioned that literally on Monday morning. So we can't be complacent. The 10-year, everyone's talking about, wow, we've already gone 100 basis points since the Fed started cutting. Luckily, I really have a thing with yields and dollar because I pay attention to them, and oil. I think they're really, really important from a macro 3 legs of the table kind of standpoint. And apparently this was the biggest, by the way, historic 10-year yield rise during a rate cutting cycle since 1981. And that's, where the term bond market vigilantes, which Jeffrey uses all the time, was recorded. So I love this. Anyway, point is, right now, our inflation fell when the Fed was hiking in 2022. When they started cutting in 2024, inflation expectations started to rise. So we're all upside down. If the Fed isn't vigilant about inflation, and right now, they're still, Waller this morning, out talking about cuts. There's no way to buy bonds. So we've got a situation now where policy intervention is not in the house. Trump saying interest rates are, far too high is just not going to cut it. I literally talked about this Monday pre-market. When policy intervention. So rising dollar and 10-year yield are right at a major risk-off zone. I've mentioned that 4.7 on a weekly close. And by the way, hitting it is not a weekly close. We got to get and stay above 4.7. We got to get and stay above the Dixie 109.30. We're hitting both of them, but we're not above both of them on a weekly close. This could be dramatic for the market, or it could be rejected right here, or we can have this slop, but we are here. So anyway, I was already thinking about, okay, if we're going to boldly be long equities here, then we're going to need, once again, some policy intervention. And might I remind, this is not it. this is chaos. This is not comforting the market. So this is where we're at. Talking dollar and yields will not work this time. And I kind of go through some of the reasons why I think this is, the market's obviously not feeling it yet, because Q4 is still expected to be hunky-dory. But as I mentioned, it's going to hurt corporate earnings in Q1 of 2025. All of that, cost of energy, cost of financing, and of course, the cost of the dollar conversion. So that's going to make it really hard because it's going to continue to bid up dollar and yields. So this is really where the hopium, or the hope that Trump is going to come in and suppress the dollar and yield strength like he did in 2017 to 2018. By the way, it only suppressed the dollar. Repeat, it only suppressed the dollar. And then the dollar bounced back up all the way before the blue wave in 2020, before the COVID crash. So the dollar completely went back up. So he did talk it down, but not for long. And by the way, the whole time, yields were rising. And as yields were rising and they hit 3.2%, I remember the day, October 3rd, it was too much. And I said, it's going to trigger emerging market panic. And I made some kind of quip about, they have everybody on TV saying the wrong thing. I was like, really? Like, I knew this guy. And sure enough, we fell for the next 2 months into the Christmas Eve massacre when Mnuchin called the banks, 20%. So we had a 20% correction in very short order because yields were too high. So we're always trying to find that kind of when we leave the Goldilocks zone. And I think we're going to leave the Goldilocks zone when we get above 4.79. And obviously the dollar is pushing higher all at the same time. So I don't think that's going to work. Now, the good news, you'll also hear some of the good news. And Jeffrey's opinion about really what policy intervention we need is fiscal austerity. But you know what happens to corporate earnings and multiples when that happens. So that's going to be really tough to pull off. Also, a voluntary de-dollarization. So because he had said that, I said, oh, let me go dig in and talk about a dollar devaluation as a policy. Here are the green shoots. I wrote about this on Monday. The dollar manipulation game. Shrinking the deficit is right thing to do, but will they? And it would sure cause a lot of short-term pain for long-term gain. It is very, very hard not to have equity volatility. It is very, very hard not to have higher unemployment. By the way, this morning, jobless claims, ridiculously low if we can trust the numbers. The point is, none of this has happened yet. When does the market start to price this in? When the dollar and yields start to spike higher, and energy assists, although I think energy will get rejected. Long story short, we are hoping that this is just going to be a gently falling dollar and a gradually falling yield curve, not abrupt. Maybe the peace trade will help tremendously. So the dollar could absolutely fall if Trump ends the war in Ukraine. The euro would spike, it'd be short term, but still it would last for a little while. And then we could start to repair. It is a bullish backdrop if there is peace and trade. And these were the kind of the key reasons. Dollar would fall relative to the euro. Yields would fall, especially if Trump says Russia can have its assets back. That kind of thing. But that's a big event. Forced devaluation is not a high probability in Jeffrey's bet. But if you're looking for end game, which is not my game, but then this is what you're looking for. This sequence of events right here that would cause foreign countries to sell their dollars and their US treasuries with both hands. In the meantime, duration shock, right now, his opinion is 5.5% on the 10-year. Mine is 5.3. I've mentioned that before, and it's also in that post of December 12th. So long story short, we got a situation where we're not there yet. We're not in a situation where we're going to have a duration shock, which is when the Fed was, raising faster than and inflation it was way off sides, and bond yields soared, prices absolutely in bonds fell, and it was the worst performance in decades. Huge Fed mistake, bond shock, absolute duration shock. Same thing can happen in reverse where you get rapid rate cuts. So this is when bonds are really strongly negatively correlated to equities. And this is typically when the Fed moves towards this deflation phobic phase. Think recession. So right now, all we've done is move from here to here. And soon they're going to need to defend the bond bulls. We're leaving the Goldilocks territory, which means we can have some recession risk fears, but we don't have the data for recession risk. My point is the bond market, if we get above these levels, that +4.5, really, by the time we get to +90, we'll be solidly in recession, in my humble opinion. So anyway, this is it. This is when we get closer to 90, that's where bonds will actually serve their long-term purpose of protecting against equities from falling, oftentimes because recession risk is already pulled forward. All right, so that's my macro assessment on dollar and bonds. We're all bond traders now.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.